Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help POA students like you ace your exams. Today we have got a practice question which requires you to calculate the depreciation expense for three different financial years and also find out any profit or loss we have made on the sale or disposal of a non-current asset. You can see the question on the left hand side of your screen, and on the right hand side we've got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. John Trading bought two machines on 1 January 2014 for $15,000 each by check. So based on the first sentence, we understand that on the 1st of January 2014, we bought two machines for a total of $30,000 because the question clearly mentions $15,000 each. The business depreciates machinery at 20% per annum using the reducing balance method, and a full year's depreciation is provided in the year of purchase and no depreciation in the year of sale. On 1 November 2016, one of the machines was sold for $8,000 by check. So this is referring to a disposal which we have made. And on the same day, John bought another machine for $13,000 by check, which is referring to a new asset that has been purchased. The business ends its financial year on 31 December. The requirement is to calculate the depreciation expense for each of the three financial years ending 31 December 2014, 2015, and 2016, followed by finding out the profit or loss on the sale of the non-current asset in November 2016. So let's look into the workings we have got on the right-hand side. So we understand that we are working with a business where the financial year typically starts on 1 January and ends on 31 December. So the first year of usage for the two machines which we have bought on 1 January 2014 would start from 1 Jan 2014 and end on 31 December 2014 when the business will be preparing its financial statements. Now, in this first year, we know based on the business policy that we have to calculate depreciation based on the full amount. Now, we are simplifying our calculations here because we have got two machines which have got similar characteristics. Given that we paid the same price to buy them, we bought them on the same day, we are also depreciating them at the same rate and also using the same depreciation method, which is the reducing balance method. So we are now finding the depreciation for one asset. So we know in the year of purchase, we are to do a full depreciation, and a full depreciation is calculated here by simply multiplying the given percentage with the original cost for one of these assets. The given percentage is 20%, and the original cost for one asset is $15,000, which the question clearly mentions $15,000 each. So the full depreciation for one of these assets is $3,000 for the first financial year, okay? Now, every time you find out the depreciation using the reducing balance method, I also recommend you find out the net book value at the end of the financial year. So we are finding out the net book value at end of 31 December 2014. The net book value at any given point in time is simply the difference between the cost and the accumulated depreciation. The accumulated depreciation stands for the total depreciation we have so far for this asset since the day it was bought. Because we are just in the first financial year, the only accumulated depreciation is the depreciation expense of $3,000 which we have derived. Therefore, the net book value is calculated by taking the cost of $15,000 and then subtracting $3,000, which is the depreciation expense incurred for the first financial year, and that is $12,000 as the net book value. Again, we understand that this is only for one asset because we are simplifying our calculations. Now we want to find the total depreciation expense for the entire financial year ending 31 December 2014, which is going to be pretty straightforward because we have got two machines with similar characteristics. Because the depreciation expense for one of the machines based on our calculations is $3,000, we can just simply multiply this number with 2 and we arrive at the total depreciation of $6,000, which is valid for two machines for the financial year ending 31 December 2014. All right. Now let's look into the next financial year. So the next financial year will start on 1 January 2015 and end on 31 December 2015. We are calculating our numbers again for one asset just for simplification purposes. So if you want to find the depreciation in the second financial year using the reducing balance method, we now multiply the given percentage with the net book value. The given percentage is 20 and the net book value is $12,000, which you recall we have derived at the end of the first financial year for one asset. So that gives us a depreciation of $2,400 again, which is only valid for one of these assets or one of these machines. Now, why do we call it the reducing balance method? Because if you check your depreciation in year one, it was $3,000, right? And now in year two, it is $2,400. So every year we move forward, the depreciation is expected to go down in value. And this is mainly relevant for items which are highly technologically obsolete over time. For instance, you could look into software, or you could look into cars, or you could look into computers. Because in the first initial years of usage, those assets can provide more benefits compared to the later years, and that's why it makes sense in most cases to depreciate certain items using the reducing balance method. Okay? Now, let's find out the net book value for one of these assets at end of 31 December 2015, which is at the end of the second year. Now, the net book value in this case is very simple. Because we already know the net book value from the end of the first year, we just simply take that number, which is $12,000, and deduct the new depreciation of $2,400, and that way we get the net book value of $9,600. This formula already factors in the accumulated depreciation because the $12,000 that we have here initially had already deducted the depreciation from prior year, and now we are only deducting the new depreciation expense of $2,400, which is valid for year two, and that gives us a net book value at end of 31 December 2015 of $9,600, which is again valid for one asset or one machine. Now, how do we find the total depreciation expense for the financial year ending 31 December 2015? It's pretty straightforward because we have got two machines with similar characteristics. Because the depreciation for one of these machines is $2,400 based on our calculations, we just simply multiply the number with 2, and that gives us $4,800 as the total depreciation expense for the financial year ending 31 December 2015, and this is valid for two assets. And this $4,800 is what we will report in the statement of financial performance or the income statement. Okay? Now, let's move into the third financial year. The third financial year will start on 1 Jan 2016 and end on 31 December 2016. And you have to be careful and aware of what's happening because in the third financial year, many events have occurred. First of all, we know that in November 2016, which falls within this time frame, which is 1 Jan 2016 and 31 December 2016, within this 12 months, we have disposed one asset, we have sold one asset, and the asset which we have sold is one of these machines which we bought initially. Now, we understand based on the business policy that we are to apply no depreciation in the year of sale. All right? So what's the net book value for one of these machines which we have sold? It's $9,600, which we calculated at the end of year two, right? And we ended up selling this machine for $8,000 by check, which is clearly mentioned in the question here. You can see I'm highlighting in yellow and then again with red, okay? $8,000 by check. So we ended up selling this machine for $8,000, which is the disposal proceeds. At the moment of sale, the machine had remaining value of $9,600. What do we understand by the net book value? The net book value simply refers to the economic benefit still available for consumption and helping the business generate more revenue. So this machine had $9,600 worth of value left, but we ended up selling it for $8,000, which means we have ended up selling it for less than what it was worth at this point in time, which means we have made a loss on this sale, and the amount of loss is simply the difference between the net book value and the disposal proceeds, which is $9,600 minus $8,000, and that is $1,600. So we have already answered part B of the question, which we are required to, because it was as part of our working, so we might as well finish it, okay? Now, let's look into the depreciation we need to calculate for the other machines. Now, from the original initial batch, which we had for two machines, one of them has already been sold. We understand that. But then there's this one old machine which still remains. So how about depreciation for the remaining old machine? The remaining old machine is just going to follow the usual reducing balance method of depreciation, which is that we depreciate by multiplying the given percentage with the net book value we had for this machine at end of year 2. This is 20% multiplied by 9,600, which is $1,920. Now, my question to you is, don't get confused. Are you getting confused here though? Because the net book value is the same as the net book value of the machine which we had sold. We shouldn't get confused because we know both of these machines had similar characteristics in nature. So if one of them has already gotten out, then the other one which remains will still have the same net book value, right? So here we are finding the depreciation by simply multiplying 20% with the net book value of 9,600, and that gives us $1,920. Okay? Now, we know the day we have sold our machine, we have also bought a new machine. And the new machine which we had bought will go through a full depreciation because that's what the business policy is, right? So the full depreciation is derived by simply multiplying the given percentage of 20 with the original cost of $30,000. This is the amount we paid to buy the machine, which the question clearly mentions. And you can see I'm just circling in red, all right? So 20% multiplied with the original cost of $30,000 gives us $2,600 as the full depreciation that we derive for this new asset which we had bought. Now, what's the total depreciation expense for the financial year that starts on 1 Jan 2016 and ends on 31 December 2016? It's $1,920, which we had calculated for the remaining old machine, plus an additional $2,600, which is the depreciation for the new asset that we have bought, altogether, which gives us a total depreciation expense of $4,520 for the financial year ending 31 December 2016. All right, that's it. That's all for this question. I believe you have got some understanding of how to handle similar stuff during the main exam. You can check the link in the description to book a free Zoom call with me and discuss your online tutoring or coaching requirements so I can help you get your results for the exams that are happening at the end of the year. With that being said, I'll conclude today's lesson and I'll see you in the next one.